Hello and welcome to the follow-up Q&A session of our recent insurance event that took place in London. Here today we have Giorgio Baldassarri, who heads up our analytical development group, and myself, Gustavo Tella, who is going to be hosting this session. So Giorgio, thanks for being here today, and I'll start with the first question.
Yes, Gus.
How do we treat qualitative inputs into a quantitative model?
This is a bit of a nasty question because obviously this is a bit hard from a quantitative point of view. Qualitative elements like the quality of management do add value to the models, and the trick is actually to identify some proxies that can never be perfect, obviously, but we have evidence that they do add value. Yes.
Could you comment maybe a little bit more on the qualitative management?
Yeah, the quality of management probably is a bit hard, but what we do is we tend to use, for example, the sales growth as one of the potential quantitative elements or proxies that we use in that case.
Thanks for that. And also in our session, we talked about market-driven models, where the inputs that go into the model are coming directly from market observations. We talk about fundamental-driven models, which come from fundamental inputs. Could you comment a little bit about how forward-looking those different models are?
I think they are all forward-looking. Because obviously market-driven models tend to incorporate the views on the expectations of the market itself, whereby fundamentals models also, especially those that are trained, for example, on the ratings, tend to incorporate the view of the ratings. And as such, for example, for the ratings, their assessment tends to be more long-term, so between 3 to 5 years time horizon for investment-grade companies and 2 to 3 years for non-investment-grade companies. So the difference probably is more about how often or how frequently these outputs from the models change, that it is on a daily basis for market-driven models and on a quarterly or annual basis for models that are based on fundamentals data. But they are both forward-looking.
Thanks for that. And the final question that we have time today is how are globalized companies, so companies that operate in multiple countries, are scored through the eyes of our models?
We tend to, at the moment, apply the country of residence, actually the country where the company is headquartered. However, to companies that and clients who want to assess companies that are global in nature, we tend to suggest another approach, that is that one of assessing companies, the same company, using different country risk scores to consider the different countries where the company is operating, and then combining everything together to achieve a better assessment of credit.
Thank you, Giorgio. And this is all we had time for today. And thank you for watching.